What is a money market? We get a lot of questions around money markets right now because they're at their highest demand since 2008, but there's a lot of confusion. That's what we're going to cover here today. Money markets are the talk, Valerie. We gotta make sure we differentiate, though, what the different types of money markets are and the differences between savings accounts and also what investors should be looking for in this episode of Your Life Simplified. My name is Michael MacKelvie. I'm a certified financial planner, also joined by Valerie Escobar, certified financial planner. Make sure to subscribe if you haven't. Valerie, help us understand, just to start here, the difference between a money market fund and a savings account that you might find at a bank.
Yep, I will do that. And to add to the confusion, I will also throw in a money market, just a good old money market versus a money market fund versus a savings account.
We should differentiate that as well.
So these are finally being interesting. Like you said, we haven't seen something that's actually paying us more than negative percentages. Not actually, but basically nothing at the banks. So let's start with the basic savings account. When you go to your bank, you give them money. They pay you a little bit. Right now, they're paying you quite a bit in historical terms. And they use that money to lend it to other bankers, right? So anyone that comes in and they need a loan, they can make money on that, and they pay you some interest in exchange. Now, with that, the bank is who's taking the risk. Your money is supposedly always going to be there exactly as it is. That's why we have insurance on the banks. We have a different episode that you might want to check out about that. But that's the biggest difference. That with a savings account, that's where you're at. You get the lowest interest rate because it's the safest. If you want to do a little bit of a step up, now we've got our money market that's at a bank. These will usually allow some check writing, couple of extra features, a little sexier, I would say. But again, this is still regulated by the banks. You're not taking the risk. They're doing a little bit of extra stuff with it. And then the third piece that we're going to add in here is the money market fund. Now, this is actually an investment. We'll talk a little bit more about that, but effectively with this one, there's no guarantee that it'll always stay exactly at $1 per share. There has been a history for what we call breaking the buck. And so there is an investment component, which we'll talk a little bit more on too.
Yeah. And I think some key differences there, because the money market fund on average is typically paying more. Yes. And this is in line with the fact that you are taking a little bit more risk. Right. So there's that insurance that exists there for a savings account up to a certain amount, FDIC insurance, right? A money market fund, there are underlying investments, but what I find is that very few people understand what is actually within the money market fund. Why is this seen as maybe a lower risk investment in comparison to, let's just say traditional bonds or stocks? So I'm going to cover that real quick, just so people understand, well, what the heck is even in a money market? The maturity in the debt is short term, so typically 397 days or less. And it's AAA rated debt if it is debt within that piece. So the credit quality, again, AAA rated, but also as far as diversification, the money market can't invest typically more than 5% in any one company except for the government. So you'll actually see different types of treasuries within a money market quite often here, which again, if we're talking about the risk-free rate, this is what we're alluding to, treasuries typically, right? So the participants in the market are large professional institutions. So this is where you'll see Charles Schwab, Vanguard, right? These big companies that have these money markets. And I will say, in a lot of ways, their reputation rides on keeping the net asset value at $1. So you mentioned breaking the buck. That has been rare because even if, let's just say, Fidelity, a massive company, were to break the buck, the confidence for investors as far as using Fidelity for various things would definitely be rattled a little bit. So companies have quite a bit riding on the line when it comes to keeping money markets NAVs at least $1. And again, you get paid on a money market through interest, not on appreciation. And,
Right.
looking around at different money markets right now, it's easy to understand where there's this demand because there are several of them that are paying north of 4%. I mean, we didn't see anything close to this a year and a half ago. Obviously, interest rates are a part of this. So, now, I think it's also worth noting here in helping people understand, as far as the underlying investments, why is it that a money market is maybe is able to, be less interest rate sensitive than maybe other debt investments? And Valerie, do
Mhm.
you want to touch on that real quick? I got a couple notes on that, but I think we should also cover that.
Yeah. No, with anything, I mean, interest rates will vary all over the place. They always focus, as you said, on shorter term debts. There's a term called duration. And generally, what that means is the smaller the duration, the less of an impact that current or changing interest rates will have on there. And so that'll be really one of the biggest focus. And so some of those types of securities, as you said, government bonds, but we're also looking at different kinds of CDs. We've got commercial paper. Any of these types of investments that banks really don't have access to. And so you'll see these in those brokerage accounts.
Yeah. Yeah. And, within the money market, because it's shorter. Okay. So if we think of just any debt obligation, let's say interest rates go, let's say the Fed comes out and they say, we're going to raise rates from 3 to 4%. Okay. If you have a debt obligation that is 25 days long, well, you can then roll that debt into the next higher interest rate when that comes due, right? So there's less change
Mhm.
in that interest rate, or sorry, in the price of the overall debt holding, right? Whereas if you had a 30-year obligation, which you would not find within any money market that I have ever seen, at least, the price sensitivity there would be considerable with a 1% increase. This is actually part of the reason, really the entire reason why SVB, for example, Silicon Valley Bank, got in trouble. They had a lot of 30-year underlying treasuries, and with interest rates going up significantly, the price really shook the bank's underlying holdings.
Right.
So
And one of the things too,
important to
when we're
highlight.
yeah, and with savings accounts, I mean, everything has its purpose and place, we can say that, I suppose, broadly. But those long-term bank loans, I suppose, if you wanted to lock something in for 30 years and you're like, this is a great rate, I just want it forever. Sure, that could be appropriate. But if we're talking about money markets, we're talking about stuff that generally needs to be pretty
Shorter.
accessible. We're going to
Yeah.
focus on the shorter term stuff.
And that is another key difference between money markets and maybe CDs. Money markets might have CDs as a part of their investment holdings. Sometimes you may see this as far
Hmm.
as just different investments that are within the money market fund. But the liquidity is the benefit of the money market, right? So CDs, typically there's some interest penalty if you want to bounce out of them. Money market funds, you don't have that same issue. It's a
Right.
fund. So you can sell out of that fund and take your money, so long as everybody's not doing it at the same time and there's not, some massive shock that's occurred. You should be okay in that scenario. And sometimes we get the question here, Valerie, what happens if the institution fails? So what happens if, I got Charles Schwab Money Market Fund, or I got Fidelity Money Market Fund, or pick any big, massive financial
Hmm.
institution that has a money market fund? What happens if either of those companies or this company fails and I have a money market fund there? Uh, there's a difference. And if you actually
There
look in the
is.
regulatory docs, you'll find that there's a separation kind of church and state here, if you will, right? You have the custodian, and then you'll have the company, right? So, thankfully, after the most recent example, as far as like why there's this separation, is Bernie Madoff. We had to separate, the investment worlds has to separate these two. So if, let's say, a Fidelity crazy event happens and Fidelity were to fail, there was no bailouts of any kind, something that would be unprecedented for our country. Um, you can look at the underlying holdings and understand, again, there's a custodian that's separate from Fidelity in this case, where your monies would be housed, where your investments would be housed. The creditors couldn't come in and say, okay, well, we want to take, assets from this money market fund. It's separate. They would not be able to do that. Okay. So
Hmm.
I think that's worth noting, because a lot of times this conversation is coming up when people are wanting to be safer, take on less risk, and be more conservative. with their money. Creditors can't reach in if an institution were to fail from when we're talking about money markets funds. And you can see this within the regulatory docs, which I would say is worth maybe taking a look at if you're going to be investing a considerable amount into a money market fund.
Right. And then to that point too, we talked about FDIC insurance that exists at banks with 200, generally that number is $250,000 worth of protection per investor or per customer, I suppose, for an account. With a money market fund at a brokerage account, we have SIPC insurance that has that $500,000 number attached to it.
Yeah.
And then also, within a brokerage account, you usually have additional options that we can say with brokerage CDs. This is something that's sort of a money market alternative, but basically, we can place it on a whole bunch of different banks all at once.
Yes.
And that insurance has come in really handy. Like you said, there's a custodian, which is the person who actually holds the bank. And then there's, the manager. So Mariner, for example, with Bernie Madoff, it was all in one. SIPC.
Yeah, you don't want that.
You don't want that. We learned that lesson.
Anymore.
Yeah. And luckily, SIPC did step in to help with those investors. I think that's still ongoing after, I can't remember how many years. But yeah, we've improved our situation by not allowing that to happen anymore.
Yes. Yeah. Regulation is a good thing in that way.
Yeah.
Right.
Mm-hmm.
Now, worth noting just the different risks that can be there for a money market fund. Again, this is not like, let's just say a savings account that has the FDIC insurance. So one, I would review what the fund is holding. And I will also say here, there are investments that do float around from time to time, alternative investments. They seem to be that really try to make their image look like a money market fund. So one that I could think of, and I remember seeing actually a TikTok for this, for the SPX fund. And it was paying 7 to 8% when nothing in the money market fund realm was paying close to this. So obviously that wasn't a true money market fund.
Right.
And investors got in trouble there. So I would say make sure to review what the fund is holding. That's where I always show people, hey, here's everything that's within this. Here's the treasuries. Here's any commercial paper, right? These are known as really conservative assets historically.
Mm-hmm.
I would also say, keep in mind that return is tied to risk. So if you do see a money market fund that's paying maybe 4.5%, 4.6%, and one's paying 4%, well, there might be a little bit of a difference in the underlying holdings, even though it might not be, massively significant. There might be a little bit of difference there in the risk of the holdings, and that's why one is maybe paying 0.5% or so higher than the other. The last piece I would say here from a risk standpoint, major firms on average are typically funded better to be able to sustain short-term volatility. So they're just larger companies. And because of that, they're typically funded better to just withstand short-term volatility.
Mm-hmm.
I actually have a white paper to back that up. But again, I would say that that's something worth noting if you're looking out and you're really worried about, okay, I want to make sure that this money is safe. Some important pieces there when it comes to net asset value and not having to break the buck for the company, right?
Yeah. And Michael,
all things to be, considerate of.
Yeah. And a couple of last notes on my side. As you said, all money markets are not created equal. If it looks too good to be true, it probably is. That's always a good rule of thumb. Secondly, when you're looking at even savings accounts or money markets at a bank, brick and mortar banks will have higher expenses, obviously having to pay for a building. And so you'll usually see that online only banks can offer better rates. So that's worth looking into. And I think the last thing is that if any of our viewers have ideas on other TikTok channels besides the money market TikTok channel for you to hang out in, let us know, because I think you could use that.
Yeah, definitely. Well, the funny thing is I was sent this video and somebody asked like, hey, how legit is this? And this is, again, it's very easy.
That's a good excuse.
That money market TikTok, jumped out at me because at the time money markets were paying maybe 1.5%. And this one was paying 7 to 8. And I was like, there might be something there that is a little bit of a red flag. So
Good
Anyways,
instincts.
well, hopefully this was helpful. Again, we wanted to sort through a little bit of the noise when it came to money markets, money market funds, savings accounts. If you have questions on this, feel free to click the link down below. We are getting a lot of questions around money market funds. Be happy to hear you out. But otherwise, make sure to hit the subscribe button to get more industry insights from industry professionals here at Mariner Wealth Advisors. You guys take care.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.